This is the European edition of Breaking Banks, the world's #1 fintech podcast and radio show. We bring you the European unicorns, startups, founders, regulators, and leaders innovating the rapidly evolving fintech scene today. A truly localized podcast with both English and local language content, with some of the world's most well-known hosts and influencers in the fintech sector globally. Join us every week as we explore what makes the European Union a phenomenal proving ground for many of the fastest growing fintech plays in the world today. Okay, let's roll.
Welcome to the 42nd episode of Breaking Banks Europe and Breaking Banks. Today we have a really special panel of guests talking to us about a really exciting topic. And the topic is decentralized finance. Now, if you are from a bank or a neobank, you might be wondering what the hell we are talking about, but we'll explain that during this episode. And with me, I have my famous co-host, Paolo Cironi.
Hey, Ajit. Everything is good in London?
Absolutely. It's really hot, and I'm glad this is a podcast and not a YouTube video because I'm burning here. Anyways, so with me and Paolo, we have Stani from Aave, the famous Lend token. And we have Rune Christensen from MakerDAO, the base layer of DeFi. And we have Lex Sokolin, very well known in the fintech community. And he's also the global co-head of fintech at Consensus. Guys, please say hello to our audience.
Hi, audience.
Awesome. So today we're going to talk about decentralized finance. And, without taking too much time, I'm going to start with Lex. Lex, what is decentralized finance and how is it different from how the financial industry works today?
I'm going to give a roundabout answer because I have to. So the core answer is that people take financial actions. They pay, they save, they lend, they invest, they trade, they insure, and they retire. And this is true in 2020. This was true in the fintech era of 2010 to 2020. This was true in 1995. It was true in 1900. It was true in the 1500s, and it will be true in the year 3000 if the artificial intelligence haven't all turned us into goo by then. Decentralized finance is the most modern instantiation of these things that people do. It is a blockchain-based financial services ecosystem, and it is composed of a number of different protocols or projects, which are represented by a couple of the excellent panelists here. And those projects allow you to do the things that you would normally do in a financial services ecosystem, like lend, like pay, like save, earn your interest, trade, and so on. They just happen to be running on infrastructure which requires for you to understand what it means to have open source programmable software. And so it's not as foreign as people might think because it's the usual stuff, but it's designed in a way to be far more empowering, far more cost efficient, and far more interoperable than anything we've seen so far.
Right. So you're doing everything we're doing, or other banks are doing, and the current market infrastructure is doing, except you're doing it on a public blockchain using smart contracts and other pieces of code, where everyone can kind of see transparently what's going on. Is that correct?
That's part of it. Yeah, I think, again, different people will lean into different positioning, but for me, it's like you have the software that you normally would have doing core banking, or the software that you'd normally have doing portfolio management or institutional capital markets, your rebalancing systems, your trading systems, your underwriting systems, Fiserv, FIS, Jack Henry, Envestnet, Temenos, Refinitiv, right? These companies which are the software, the middle layer on which exactly, yeah, where both the data sits and the functions and the workflows, where all those things sit. Forget about what you're putting on there as exposure, just the software that manufactures the asset. DeFi, just start to finish, can replace a lot of that by creating decentralized, like vending machines, where you come to some smart contract and interact with it in order to
Right.
generate this asset class. And I think that's the really powerful stuff.
So we're putting vending machines on the blockchain. So Rune, you've got something really, really interesting, right? The first time I saw your presentation was was in Cancun. What a wonderful place. And I was really excited about it from that day itself. So what is Maker? What is the Maker protocol? What are you actually building, and why is it called this base layer of decentralized finance? What's the big idea?
So Maker is at its core really using blockchain technology and using smart contracts to create some of the most primitive functionality of what banks do, for instance, or what money does. So really also to Lex's point that this is about it's about doing the same thing that you already do with finance and with banking, and just using modern technology to really take it to the next level. And so one of the things that make Maker so unique is that just like with a bank, you can borrow from Maker, right? You can, and the way you do it is you lock collateral into the protocol, kind of in the same way as you pledge your house, for instance, to a bank. And then you after you pledge your house as collateral to the bank, you can get your mortgage, you can get your loan. And the same thing is possible with Maker. The only difference is with Maker, you can do all of that in a single atomic transaction, as it's called, right? So you can actually go through the entire life cycle of originating a loan, it takes about 10 seconds or so for it to confirm once you decide to do the transaction. And that is quite a difference, right? I mean, that just opens up for a lot of new possibilities when you get this kind of efficiency and speed added onto the existing financial functionality that exists. And Maker is, of course, also about creating money, because it's about emulating or doing the same things as some of the core services a bank delivers. And the way that's achieved with Maker is through the creation of a stable cryptocurrency called DAI.
Right.
That's actually it's really DAI that can be considered the base layer of DeFi, because it's a cryptocurrency. It's worth $1, and it's essentially used all over the whole DeFi space as kind of like the way to represent money and stable assets when you're trying to, for instance, make a trade against something else. Then you need DAI in order to buy some other DeFi asset, for instance.
Right. So what Maker is doing is something akin to a commercial bank that's issuing money, or a central bank that's issuing money, and the DAI is that money pegged to the US dollar. And Maker is what is Maker for? Maker is this asset which is used for participating in the governance of this protocol.
You have a two-sided market where, on one hand, you have the stability seekers, right? So the DAI users that are using money, they want to save, or they want to spend, they want to transact, and they use DAI for that. And it's a very stable, predictable tool to use, right? It's not really, it doesn't feel like crypto. It feels like your bank account or a credit card or something like that.
Right.
On the other hand, you have what's called the vault users. So this is where the whole lending aspect comes in, where just like in a bank, you can pledge your house and take a loan. In Maker, you can do the same thing. You can lock assets as collateral into the protocol, and you can get the loan out. And then the third actor in the ecosystem is the Maker holder and the governance itself of the entire platform. So this two-sided market needs to operate with some sort of rules in place around what's the price of risk, what's the exposure that the protocol is willing to take to different assets. And ultimately, all of those decisions, unlike in a company or a bank where it's a CEO and the risk committee or something that makes those decisions. In the Maker platform, because it's decentralized finance, there's no single authority or single company that makes those decisions. Instead, the entire community decides it and sort of collaborates on what kind of parameters to set in the system and what kind of decisions to take through the internet, and ultimately through the blockchain, through voting, with this token called MKR. And the trick to the MKR token is that it's a token that gives the holders exposure to the performance of the system. So if the system is operating really well, they'll earn from it. But then on the other hand, if there's a problem in the system, so if there's some collateral that turns out to be bad, or there's just been a misallocation of exposure, then you could actually have bad debt or a buildup of risk or some sort of loss to the system. and that loss is then assumed by the MKR holders as sort of the that's what they contribute into the system.
Right.
Underwrite it.
Right. So this reminds me of the mortgages. So there's a lot of financial engineering here, right? And the dark secret of this episode is that Paolo and I have some financial engineering experience in our past lives. So I mean, critics
we have
of
our sense.
we have our sense. So we have some things to hide, right? So So some critics of DeFi say that there is a lot of financial engineering involved in DeFi, and because of the history of, we've had our great moments, and we've had some problems, to put it mildly. So people worry about the level of financial engineering involved in decentralized finance. Are these concerns valid?
What's really cool about DeFi is that it's all about accessibility. So you can really access anything you want in DeFi, no matter who you are, because that's sort of the whole fundamental premise of blockchain, right? It's available to anyone at any time. And that does mean that if you go out looking for extremely risky and complicated financial instruments in the DeFi ecosystem, you're absolutely going to find them. Mm-hmm. And there are a lot, there is just a lot of experiments, a lot of risk, sure. And you could even say a lot of danger out there, right? For people that don't know what they're getting into. Mm-hmm. Mm-hmm. But there's also plenty of projects that aren't, trying to really maximize the complexity, for instance. And Maker is absolutely one of them. So the approach that Maker has taken is to focus on this base layer infrastructure requirement, right? Of creating stable money that can be used by other applications just as money, as cash, and then a lending platform and a collateralization system that functions similar to a bank balance sheet that can be used to provide the hard assets to then ensure the stability of the monetary system.
Wow.
There's other examples as well of projects focusing on doing a simple task. There's like Uniswap is a cool example.
Yeah, I'm a big fan.
Yeah, like it's an automated market maker, right? So it's like a simple smart contract that anyone can use, and if you use it, it doesn't matter who you are, but it gives you access to actually the full sort of the full market making experience, right? Where you can deposit some assets, and it will automatically trade them for you. And each of these applications on their own are actually quite simple and not really that risky, right? If you spend some time learning how to use them, you can absolutely use them safely. Yeah. And sometimes what happens in DeFi is people start chaining multiple different protocols together to get more advanced functionality. And I think that's where you can really get into the weeds of just how complex it's possible to make this. I mean, and again, I think that it's not something that's for most people, right? To really combine a lot of different stuff together. But
so it's like the good old Wall Street the risk is that you could create another Wall Street like experiment where you have lots of layers of risk, and after a while you kind of start to lose the benefits of transparency and openness and automation that comes from creating all of these wonderful smart contracts. Now, Stanny, you and I go back sometimes, so we are both. Amongst other memories, we are both visitors of the great blockchain cruise, I think, in different years. And this year, unfortunately, because of COVID-19, we can't do that. So what's Aave protocol about? What's Lend? What's the Lend token? What are you doing in DeFi?
I miss those cruises, by the way.
For sure.
So basically we started as kind of like experimenting DeFi a few years ago with the project called ETHLend, short for Ethereum Lending. And that was basically first kind of like an on-chain over-collateralized lending protocol where we matched lenders and borrowers. And over the time, the DeFi space basically started to evolve a bit more. So some of the assets that we were using as a collateral became more liquid, and kind of like you could scale a bit the lending infrastructure that basically we had then. And some other things changed as well. MakerDAO came with the first kind of like a stable coin on Ethereum, and back then there wasn't actually anything else. And this kind of led to interesting scenario for us where the DeFi space evolved into this kind of like a value locking space where you kind of like measure the trust in different smart contract protocols based on how much you lock value and how much users are locking funds there. And usually they are based in some sort of like either or collateralized system or just placing liquidity. And we basically rebranded into Aave last year and wanted to kind of like continue the DeFi narrative, but to create something a bit of like, somehow improve the space. And like we see at Aave, the way of locking assets kind of somehow like very efficient, but also inefficient in the way that basically all capital should be somehow utilized. And we tried to create a lending market where the capital is utilized as efficiently as possible. And basically we launched beginning of the year the Aave protocol, which is kind of like
So the big idea is that because you're lending in a decentralized network where the identities of the counterparties are not known, therefore you have to lock like 100% or 120% collateral in case there is, the collateral value moves and as a result there is default and whatnot, and there is no way to get the money back in a decentralized pseudonymous network because you don't really know who actually borrowed, and you can't go to their house or call the police or something. So that's a very interesting challenge, and I think a number of people are trying to solve that. So you're essentially operating a lending protocol, right? And what can I borrow from Aave?
So basically you can borrow. We have roughly 18 different assets that you can actually borrow, but I think most of the traction in terms of borrowing is stable coins. And
stable coins are essentially, these crypto tokens, like crypto assets, which are pegged to the value of a fiat asset or some other real asset in the world.
Yeah, exactly. For example, DAI is one of the stable coins. So whereas MakerDAO system is a place to basically collateralize to create DAI, our protocol is a place to basically where you can deposit that DAI and borrow against other assets. So when you deposit stable coins, you basically create yourself a credit limit, which you can actually exercise yourself or delegate to some other person you trust.
Right.
So actually, you actually use the word police, and the amazing audience of Breaking Banks knows that typically you are the bad cop and I'm the good cop when it comes to finance and conversations. Today, we want to switch. So I can be the bad cop and the good cop in DeFi, right? So what I heard so far is that DeFi is basically something like what financial markets and banks have been doing so far, which doesn't make me comfortable at all, because we all know that they should do better. They actually know themselves. They need to start doing differently. But we said basically that they do it more automated, with more efficiency, faster. Ajit, you said that there will be more transparency. That this is a hot topic close to my heart. But the language we used is very institutional. We talked about architectures. We talked about mechanisms. However, in finance, nothing is really money, it's all retail money, right? So I would like our guests to help the audience understand a couple of things. First of all, if we think about the intermediaries that play the financial markets game, what is the benefit effectively for them of DeFi, and what is the threat to their business model? And when it comes to the final consumer of finance, which is everybody of us, our friends and families, if we can more clearly explain to the audience what is the benefit that the DeFi brings to them, but also where we can see a potential black swan, whether you believe it will happen or not, doesn't really matter. I would like to know if you see that there is a potential threat or problem that can materialize and where that would come from.
So I'm going to hop in on this because I love the question, and this allows for an opportunity to reflect on the last 10, 20 years of tech development in finance. And prior to getting into blockchain and digital assets, my background was in robo-advice and in digital wealth. And so I spent a lot of time thinking about B2C, B2B2C, and what is the consumer or user experience with a financial advisor, and then with banks and direct trading apps and so on and so forth. And I think the customer-centric approach is super important. However, I think there is a broader observation, which is that for all of the 500 billion of venture capital that has gone into financial services, we've gotten nothing. All we've gotten is Robinhood and Revolut and a price collapse in digital lending, in trading, and in asset allocation. So primarily what we funded through fintech venture capital is the mobile experience, the storefront, taking the experience of interacting with financial product, digitizing it, and putting it into a modern storefront that is better aligned with how some generations interact with financial products. So we've changed distribution, but we've never changed anything about how the product is made. We've essentially created a Spotify of CDs because the accounts, whether they're bank accounts or whether they're brokerage accounts, they're all the same thing as they were 80 years ago, roughly speaking.
We're just putting a mobile front end on top of the same.
Exactly. So where you get to now, and the reason why this space is so interesting is we're talking about the manufacturing of financial products in the same way that digitizing a music file permanently broke the entire music industry and disempowered the labels until Spotify cost $10 for all music ever. Similarly, I think we have an opportunity here with DeFi to restructure the entire manufacturing process, which, by the way, is the same stuff as always because that's finance, but annihilate literally to zero the costs of that manufacturing process other than the cost of capital and so on.
Okay,
and then you ride exactly the same rails follow that you would ride before. So you might ride the Robinhood and the digital lending rails. You might ride the high net worth financial advisor rails. And the value propositions for the customer don't have to change. But what does change is the underneath the thing itself, you simply eliminated a $1 trillion cost that is there to manufacture the product.
So you're saying, I mean, my belief is that the value ultimately is never in the product. The value is always in the capability of the general public to self-direct themselves and to make the right financial decisions for their life, being aware of those decisions, because right doesn't mean that you always win. It's finance. It's a probabilistic framework. So what you tell me here is that the biggest element here is the fact that the institutional players, manufacturers, and those that connect to them for distributing these opportunities or chances will be capable of operating at a cheaper cost, which might end up into cheaper access to financial markets for the final public. But basically, that's it. It's really
it's far more drastic than that. It is far more drastic than that. So, and sorry for this is like the thing I'm very excited about is it's far more drastic than that, because in manufacturing, in financial services, there's two things. One is manufacturing the asset class, or if you think about the investment fund and the stream of returns it generates, or you think about the savings rate coming out of holding of the MakerDAO project, or whether it's the lending markets enabled by Aave or any other sort of investment return. That's the exposure, and the exposure gets fit into an asset allocation and gets funneled however is appropriate to the client. The other thing is literally what the product is. So like holding a security is holding nothing at all. You're holding a number on a screen, on an abstraction, underneath an allocation software, underneath a spreadsheet, underneath another spreadsheet that connects to a CSD that rebalances once a night. You don't own anything. You're literally just staring at a number on a screen, whereas that entire value chain, the infrastructure of the financial software, is entirely rebuilt bottoms up on DeFi.
Yeah, Lex, you and I never got a chance to argue about this cost of finance will go to zero punchline, and that's because we both used to work for the same company. So now, but I'm going to ask you today, and I'm going to ask our fellow, our other guests as well. Look, the cost of finance comes from risk management, right? There is a lot of compliance. There is a lot of market risk management, credit risk management, operational risk management. There is capital that needs to be held. There is liquidity and reserves that need to be held. And that's what really creates a ton of cost in finance, right? Even more than the people costs and process costs, the capital, liquidity, and other regulatory and risk management costs are what really makes finance so expensive. I mean, people talk about opening access and financial inclusion, but the biggest barrier to financial inclusion today is literally, well, the AML regime, right? And the cost of KYC. So I mean, how do you manage risk in decentralized finance? So Arun, this is for you, and Stani, for you. How do your risk management operations work in your respective businesses?
Yeah, so I was actually touching on that a little bit earlier, that ultimately, because Maker as a DeFi protocol is completely open, completely leaderless, controlled by the community, again, there isn't like a risk committee setting the different risk parameters, as we call them, right? So things like, the loan to value ratio and the interest rates and so on. But instead, those parameters are set by the community as a whole and voted on by this MKR token. And so first, let me just talk about like how do you come up with a proposal and how do you actually get something to a vote, right? Because that's kind of like the operations aspect of doing the risk management. And it's actually a very diverse process. So basically, it's both possible for sort of outside experts to propose something to the community, or it's possible for full-time employees to basically conclude something with their models and then propose that. And no matter what, like no matter how that input gets into the system, there's also a way to compensate for that work. So there's this, like it's kind of like a new model for an incredibly open and free market for basically risk management work, where there's a much broader ability for people to participate and lots of different basically types of individuals that get to participate in that market. But then more importantly is, so now you have this, this proposal, basically this idea for how should we price the risk of, let's say, a house or something, like a tranche of houses, right? But then the second aspect is how do we make sure that whatever decision is made, we have to protect the end user, right? We can't let a bad decision impact the end user. And that's again where the token itself, the MKR token, comes in, because if the MKR token holders approve, let's say, some risk parameters are a little bit too loose for a real estate tranche, and as a result there's a loss, then it does become the MKR holders that take the loss, right? So it's very unlike, let's say, the 2008 financial crisis, right, where you had this principal agent problem, where a buildup of risk, you had fund managers and all the leaders had all the wrong incentives to pursue short-term gains, and then when the long-term costs materialized, then that was socialized, right? And with DeFi and Maker specifically, we're able to use programming essentially to directly place that burden and that cost of mispricing risk onto the people that make that decision. So MKR holders that control the system and decide what kind of risk models they want to follow ultimately have complete skin in the game. If they make the wrong decisions, they take 100% of the loss. And the hope is that this kind of paradigm, where there's a little bit of a closer connection between the users of the system and then the regulators of the system, combined with an open market and an efficient market for getting the work done using the internet and modern technology, that also creates a kind of evolutionary pressure that just allows the way that we approach risk to constantly evolve, right? And basically learn from as much knowledge as possible.
I really like this discussion because, we have the author of Financial Market Transparency, Paulo, as our co-host. And I think what you're really saying is that because there is this alignment of incentives and overall transparency in the network, there is a lot less risk that systemic risks will build up and cause the market to freeze. That's a topic we'll dig into. Stani, how does your risk management work today? And then we'll take a break.
Yeah, I think kind of like a bit of similar what basically Arun was saying. So I think in essence, like now that we have quite like in until this point, we basically have internal risk team where we apply kind of like the Aave risk framework, where we try to measure what kind of assets we're adding into the protocol. So there is basically liquidity risk. There might be some custody counterparty risk, depending on the collateral assets that there might be, or lending assets, for example, USDC or USDT. And of course, there might be liquidity risk and the market risk associated with those assets as well, because end of the day, you want to liquidate those assets in case of the value the decreases substantially. But in essence, like in our kind of like the tokenomics that we're moving into tries to kind of like do a bit of risk transfer from the depositors to the token holders in the form of staking. So the token holders can basically stake into the protocol safety
and
module.
Staking is like, you have some assets and you can stake them, as in you can park them somewhere and you can get them back and then you earn a return for that. How does that work?
Yeah, exactly. So you basically just deposit the LEND token. Well, it will be Aave token actually after the migration. And the idea is that part of those staked assets can be basically slashed, which basically means that those staked assets will be taken and sold on the market. And the idea is to compensate the shortfall events, such as, for example, if there's smart contract hack, some attack, failed liquidation, and so forth. And what is basically not covered by the stake, there is kind of like second line of defense, which is basically the minting scenario. Well, kind of third, because there is a collaterals in the protocol itself against those.
Amazing. I'm hearing about 3 lines of defense on the public blockchain. This is absolutely wonderful. Anyway, so we'll take a brief break and we'll come back right after the break to dig more into risk compliance and how a decentralized finance ecosystem will work in the long run. Thank you so much.
Do you want to be part of Breaking Banks Europe? Reach out and learn more about the opportunity to be featured in one of our shows. With over 1.6 million listeners and counting, Breaking Banks Europe is bound to become the place to advance critical dialogue in Europe and the UK fintech scene. Reach out on Instagram or Twitter at Breaking Banks EU, or go to www.provoke.fm.
Welcome back to this episode of Breaking Banks that discusses DeFi. I'm here with Ajit Tripathi. You heard in the first section of this episode a lot of language around what is DeFi, what can go wrong, why is it good for final investors, the general public, or the makers of the products and those that distribute them. I would like to start this second part focusing a bit more into the concept of DeFi as the capability of rebuilding the way finance works. So thinking about the insights I just read in an interesting working paper of the European Central Bank, whose title is Financial Intermediation and Technology. Basically, what the researchers of the European Central Bank say is that what we are experiencing now is a shift from information to communication. That means information is the core banking, the infrastructure, the adverse selection. Communication is the relationship in front of the final consumer. Now, I guess that DeFi is not about improving that relationship with the final consumer, but it's making sure that information, which is less and less relevant in making up for the revenues of financial services, operated at a completely different level with a completely different cost structure. Now, in order to do that, the panelists of this amazing episode are basically telling us that DeFi would be essential. But for DeFi to work and make sure that finance works in a completely different way, we need to make sure that the ecosystem that contributes to DeFi operates under full transparency. Because transparency is the element that will make sure that there are consequentially safex. In a way, decentralized agents are cooperating and interacting the one with the other without having, if you like, a direct oversight that imposes sanctions or makes the discrete controls, which leads into the effective risk management of decentralized finance. And the question, therefore, is, as everything is about security and risk. First of all, then will be customer relationship. How can we make sure that we have the best in class or the most appropriate approach for risk management and compliance when we are not dealing with centralized institutions any longer, and we are dealing instead with a decentralized environment? So I'm going to ask Lex, because I guess that in his recent experience, he might have some interesting insights that he can share with the Breaking Banks audience.
Absolutely. So I think risk management and understanding the risk-reward trade-off, and even understanding what the purpose of reward is really important for people who are engaging with financial services. The types of risks and exposures that come in new systems, broadly speaking, in all emerging markets, but specifically in this very frontier technology market, those types of risks often are different in a stepwise fashion. You don't know what you don't know until you learn what's wrong after you go through that process. And so whether it's, you might not have credit counterparty risks, but you might have technology and smart contract risks that you've never engaged with before. And so in activities at Consensus, we offer a software suite called Consensus Codify, which has a number of modules addressing some of these more novel problems. So, for example, we have an open source project called the DeFi score, which is a quantitative measure assessing these different novel types of risks as they relate to decentralized exchanges as well as decentralized lending protocols. So you're not just looking at an interest rate that you might get from a particular protocol, but you're actually looking at what's equivalent in some manner to a credit rating or a cybersecurity rating of a particular project. Another example would be trying to understand what compliance means in a DeFi context, because you're essentially in open sea. It's almost maritime law rather than being on somebody's sovereign ground. And so the types of compliance tools you need are quite different, and not everybody needs them. And so what we do is we provide for certain projects a way to understand what the money flows touch. So in the open waters, you might touch some sort of pirate activity or a multi-level marketing scheme, or you might touch a scam, and the funds from those sources could be tarnished, but you have no way to avoid it. And so what we can do is provide information called Know Your Transaction rather than Know Your Client, which allows people to safely navigate through these protocols. So those are just two examples of slightly different thinking that you need to apply in the DeFi asset management space. But again, I think we're just in the beginning portion of understanding what risk management really looks like.
Well, if you like, the order is always security, risk management, and experiences, right? So navigating in open waters is okay, but that's more like the security problem to me. So which is the fallback solution something happens. The risk management is something else once the security problem is being resolved. So I'm really curious to understand also from a security point of view, if we can identify situations where the DeFi would not work as expected, and therefore what could be the mitigating action in order to make sure that from a theoretical point of view, it remains sound and resilient.
Great question. The guys doing the DeFi protocols probably have the answer.
I said I'm the bad cop.
I mean, so we agreed that Paolo will be the bad cop and I'll be the good cop, and because I'm a little bit more towards the crypto anarchy dimension. So I mean, I think it and I come from the old world, so a lot of my work is essentially connecting crypto and blockchain to banks. That's kind of what I've done for the last 5 years. So I think how we see DeFi really depends on whether we are satisfied with how the financial system works today or not, and whether we believe that the risks in the current financial system are being managed, right? So yes, having looked at a lot of compliance and regulatory change after 2008, there is a lot of paperwork that's gone in. But what I think, Paolo, what we haven't done is built any transparency into the system, right? A lot of this is happening behind closed walls, and essentially auditors looking at reams and reams of paper without actual fundamental change in how the market infrastructure is put together. But anyway, that's just my slightly revolutionary view. But Arun, I think we want to hear from you, and Sani, from you as to how you see DeFi today versus DeFi in, let's say, 5 years or 10 years, and how the markets will change as a result. Financial system will change as a result.
I think from the risk management perspective, like one of the really huge advantages that you have in DeFi, both with Maker and any of the other protocols, is that you can just always go and look on the blockchain exactly what the state of the system is, right? So with Maker, we have this, one of the many websites doing this, it's called DaiStats.com. And that's a place where you basically see all the different data that exists about what is backing the value of DAI. And it's available to you in real time, right? So you can really like follow in real time to see exactly what are the assets that are sitting behind your money, so you can make your own evaluation on whether it's sound or not. Of course, in practice, this is not so much about the end user sort of spending time doing an audit of the bank, right? Because that's not really realistic. But but this is where I actually think it gets into also the whole, the experience, the relationship with the customer aspect, right? Because transparency and accessibility, isn't just about like, let's say, risk management and sort of making sure the product itself is sound. It also has a lot to do with what it feels like to interact with it, right? Because if it's completely transparent what's backing DAI, then that means that if you're using a wallet or let's say a bank or something, they can in real time provide you some nice graphs, right? Showing this is...
People can build tools to provide that insight and transparency.
Exactly right. And this is one of the absolute key value propositions of DeFi.
Like extreme open banking, yeah. Okay.
Exactly right. It's composability. Anything can be plugged together, be engineered together, and you don't need to ask anyone for permission to do it, right? It's just all there, available for anyone to use in real time.
So, Stanley, what can you tell us about? Can you give us more transparency on the Lend protocol? What do you think of the future of Lend is going to look like?
Yeah, I think like our goal, it's a money market protocol. So the idea is to create multiple money markets for different kinds of categories of assets. So we have our main market with I think 18 different assets that you can use as a collateral to borrow against. But also we have a market where you can use Uniswap liquidity shares as a collateral and borrow against. And our goal is to basically do the same with SED protocol and a bunch of other kind of like DeFi primitives that there is. But also in the future, I think...
DeFi primitives are like building blocks of decentralized finance infrastructure, right? Just to translate, yeah.
Yeah, I speak too much DeFi slang. But the idea is that I think like in the future, there will be more and more tokenized things. Tokenization of assets. And basically our goal in Aave is basically to have interest rate on those assets and unlock liquidity. So that's the kind of like goal for us.
So, Paolo, I think that this is something that you might find really interesting, right? So, open source movement has been going around for a long time. Microsoft fought it, right? And I'm not going to name other big tech companies, but they've been fighting it. And now everyone has given up, right? Open source is out here. Open source in the tech industry has won. That's it. Game over. So now I think what's happening with DeFi is open source taking over financial services. And these are like open source financial services, components being put together into libraries, being deployed on an open public blockchain. Very, very early days, it's still quite primitive, but taking this whole open source mindset and, the building blocks, public, everybody can see the code, everyone knows what's going on. That sort of approach to finance seems pretty, I think, fundamentally revolutionary and exciting to me. Anyway, over to you for more questions.
So I guess that two words were used before. If I'm not mistaken, Ruan used those two words. He said accessibility and transparency, which are interconnected, right? Because you need to be transparent on a few things, which are also the data sets that you're looking at that might shape the way your intentions are also generated. So now, in finance, we realize that there are often some blind spots that come with extra opacity on this side of the financial systems. On the other side, that they mount until they are too big, they break, and then there is a crisis and things need to be remediated. Now, can we therefore assume that what you guys think is that by means of accessibility and transparency, we will be able, with DeFi, to reduce the opacity overall on the system, and therefore mitigate the fact that hotspots can be generated because opacity can be here and there. That is not a de facto just because it's DeFi, but if you can access the data, multiple actors will be able to look at the data in a certain way, they might be capable of pointing the finger earlier than ever. Is this a fair summary of what you guys said, or I'm pushing too much ahead?
Yeah, I think that's very fair, but I think there's another element that's extremely important here, and that's also having the right incentives and having the right motives in play, essentially. Because, again, to draw the parallel with 2008 financial crisis, right? The problem was that the people who were making the decisions didn't really stand to lose anything once it blew up, right? Mm-hmm. And that's where basically the token economics of the MKR token, for instance, which runs the governance of Maker, but also the Aave token in Aave, right, as Stani was explaining, where in both cases, there's this concept of skin in the game. So it is the fact, like it's this characteristic that the people who make the decisions in the system, who decide what kind of risk model to follow, they are the ones that are both exposed to the gains of that, right, like the upside of the protocol's performance, but they also have to essentially fund bailouts if there's a loss. And the fact that they have that direct, they have their money on the line, that's going to create a completely new environment for how seriously, long-term risk management and really sound thinking around, transparency and not cutting corners and so on.
Yes, Rune, the three elements of transparency are cost, incentives, and consequences. So DeFi might be very high on cost transparency because everything that happens in a very different way and can be verified. Might be fairly high on the incentive side, you say, because it can create a realignment of the interest among the various parties. So it's not just an ex post verification of that can be somehow influenced or mitigated by different types of interest in the financial markets and in the global economy or through politics. Maybe a bit less when it comes to the consequences, but ultimately, these are the two key elements that you believe that DeFi is capable or wants to address in order to requalify the functioning of financial markets on very different bases.
I also think that it is interoperability and compatibility between what right now, it's between different protocols. In the future, it'll be between, let's say, different banks and different companies. And this ability to seamlessly connect different nexi of financial, activity to each other, and then just be able to more seamlessly engage with a broader segment of the market, right? And when you take that, when you take that on one hand, and then you also put that in perspective of the fact, the total permissionless nature of DeFi, right? That we're making this, the full suite of every single financial capability that exists right now available to everyone on the earth, right? Like even people in, the unbanked, the 1.3 billion people that are unbanked, right? With Maker specifically, one of the stories that we talk about a lot are the uses we have in Argentina, where we have a lot of people in Argentina that are suffering from hyperinflation, right? They have no trust in their government or in their banks. Just the other day, I saw this story about a 75-year-old man that he's been working his whole life and he's, been, completely savaged by inflation. And then what he's doing now is he's saving all of the money that he's earned. So he's still working today, and all of his savings go into DAI because that's a way for him to finally escape the hyperinflation of his government, right? And
no, that's only if the US dollar remains stable, right, Rune? As in, because you're pegging to the US dollar. If the dollar crashes, then we have a problem. But I see where you're coming from, but, just to...
Yeah, no, absolutely. But also what's interesting is that the dollar is that's everything in Argentina, right? That's they don't like their own currency. They really like the dollar. But in addition to just having the stability of the dollar, which to some extent they already have that through dollar bills. Of course, they can. Yeah. But on top of that, they have access to this vast ecosystem where they can pick platforms like Aave or Compound or Uniswap or any of these different things that they want to do. And there's complete access for them, right? Even though they're random people in Argentina.
Right. So here is my personal story with DeFi. So and having worked as a developer and having worked for banks, I didn't understand DeFi at all for a while because I was thinking like a banker. And then I started thinking like a developer, and it started making sense to me. So let me explain what I mean, right? So Mark Andreessen's thesis is that software is eating the world, right? And whatever can be done in software will be done in software. So when we think of financial services, and we start to imagine how financial services will be built in software, right, from the core infrastructure, from the very fundamental components like money and credit and, open market operations of a central bank and things like that. If we try to put everything in software and open source software, then what does that look like? I think that's the sort of, once you start thinking like that, then DeFi starts to make sense. But I think, Lex, you came out with a really good report on the state of the DeFi ecosystem. And I recommend all of our listeners read it. What are the 5 key learnings from that report? What's that our audience needs to be aware of?
Oh boy, this is a surprise quiz on the report, which I did not write. So I recommend everybody check out consensus.net, the research section, where we do quarterly reports on the ecosystem. And more broadly, there's a ton of fantastic resources across the web on it, whether it's DeFi Pulse or LoanScan or DexWatch or many others. This ecosystem is entirely open, so you can see the data the same way. You can look inside the machine in a way you wouldn't elsewhere.
Right,
I think,
give us the juice. Right.
Yeah. I'll squeeze some information out of my brain. Don't worry. Okay, so rough order of magnitude. If you think about the entire crypto market cap, and I think for people who don't follow it closely, order of magnitude is what's important. So we're looking at somewhere between $300 to $500 billion worth of value for various digital assets on blockchains. And then when you look at decentralized finance, again, that's a set of financial software that sits on blockchain, so it's a subset. There are other industries that you might have that also sit on top of blockchains, but DeFi is by far the dominant today. In there's about $10 billion worth of cash equivalents, whether you call them stable coins or otherwise, give or take 10 billion. And they're composed of both things like DAI coming out of Maker, as well as Coinbase-backed currencies, as well as various Eastern projects as well. And then if you go kind of one step down is how is this money applied? So one other fun fact is there's more Bitcoin today that is structured as exposure on Ethereum than there is on the Lightning Network on Bitcoin. So the thing that's supposed to make Bitcoin fast. But I think one of the biggest opportunities is in fact wrapping Bitcoin and liberating it into the DeFi ecosystem, which is a huge opportunity. So from 10 billion of cash equivalents, which is used both for payments and capital markets, you've got about 3 to 4 billion today, which is quote unquote locked, or in other words, is used as collateral for various primarily capital markets margin lending type activities, but also various derivatives and structured notes and so on. And so, that 4 billion is sitting in asset allocations. It's sitting earning interest. Some of it is highly risk exposed. Some of it is taking on very little risk. But, that gives you the flavor of it. And one of the most amazing things about this ecosystem is also community. So it's not, how long did it take Betterment or Revolut to get their first 300 million? I mean, it was a slog of 3 years and lots and lots of, at least 10 million in venture capital in order to do that. There's a project which is deeply ingrained in the community, which achieved 300 million in this collateralized value metric in about a week as of 2 weeks ago. And so because the community is so close to the investment product and has so much incentive to hold it, these feedback loops are way, way faster.
Mm-hmm. So there is that's fascinating, and I've read the report. It's really well done. Thanks, Lex. There is two things that are on my mind, right? So regulation is fundamental to financial services, right, and risk management is fundamental to financial services. So the other two things that we have a common friend, Mr. David Birch, who says identity is the new money, and I couldn't agree more. I don't see identity, reputation, and regulation being built as open source software into DeFi, so that with those we can really scale. We can pretty much do anything that current financial infrastructure is able to do. Is anyone working in the DeFi space on implementing regulation, identity, and reputation, which is kind of the basis of all credit, as open source software?
So I can talk a little bit about the regulation part specifically, because that's one of the big in my opinion, that is the big frontier of DeFi, in fact. So the question is, how do we begin to properly integrate and to reconcile the reality of DeFi today with, the reality of the financial markets and the real economy? And the answer is, it's all about regulation, because it needs to work in a fully regulated manner, of course. And so what we're doing in the Maker Foundation, as we are trying to build out these capabilities for the Maker protocol, is engaging basically with regulators around the world on one hand, and then trying to figure out how can we represent with smart contracts the same kind of behavior that a regulator expects, such as whitelists, KYC, right? Like the ability to freeze funds, the ability to track all data. That's actually easy. That comes for free in DeFi. We've been working on this for a number of years and are trying to look into how do you do things like, how do you apply the ATS regime onto blockchain-based, protocol that trades securities, and what does it look like when a broker-dealer is trading with securities on the blockchain and so on. And finally, the biggest question is, how do you enable something like a broker-dealer to allow their clients to lock regulated securities into a DeFi protocol, for instance, and it is possible. And the sort of the principle for how you do regulation is, it's called regulation at the edges, right? So basically, you regulate the parts of the system that need to be regulated, and the parts that that simply are outside of your jurisdiction, that are fundamentally decentralized and actually cannot be regulated, you don't regulate, right? But it's like, if you look at the crypto exchanges, they're all heavily regulated, right? And that's how Bitcoin is regulated. It's not, you don't try to regulate the ocean, you regulate the ports and the ships, right? And that's exactly the same logic you can apply to introducing regulated assets into DeFi. You just make sure that those assets always stay within, a regulated space.
Stanley, you have a take on that?
I totally agree with Rune. Kind of like you basically, you need to kind of like regulate the entry points and kind of like what kind of services they're providing. But in terms of if we want a technological innovation to be achieved, which is basically the permissionless ability to access to finance, I think like regulating the ocean is not the correct path. And basically it's all about regulating those ports in local jurisdictions and kind of like that's the same kind of like a vision that we have at Aave.
We are actually at the end of the podcast today because I believe we are hitting the hour. Ajit, if I can say, you mentioned that Mark Andressen said that software is eating the world. I think he was wrong, because with the exception of Excel, it is not about software. It is about platforms. Platforms are eating the world. Now, the economy is a platform, finance is a platform, but financial markets are not working as a platform any longer for a set of reasons, one of which is that there's so much opacity that the platform cannot be, if you like, efficient, therefore cannot generate interactions which are value generating for all the participants. Therefore, DeFi is attempting to do something, in my point of view, is that it tries to allow financial markets to operate effectively as a platform, and embedding a higher level of transparency inside every agent's interaction. That doesn't mean what DeFi is today is perfect. It's far from being perfect. There's more that has to happen. It's not just enough to think that we sail in open water. We just said that it's not about regulating the water, but at least making sure that the way the agents operate on that water is done in a different way. Now, those waters are fundamental uncertainty. You know what I'm getting to, right? That is the essence of finance. But we need to make sure that we don't eliminate, as we're trying to do often in financial market uncertainty, but we let agents operate in a way that they do that more efficiently than one with the other. We'll be balancing continuously, and only in an open system, which is based on open source, with an open verification, where many people can basically plug their capabilities on top of that, inside that, building tools that enable other people to see what is going on, and that we'll be able to transform financial services. It may not change the problem of communication. We said information and communication, but at least there's a fundamental step forward if the DeFi guys can make it happen, to make sure that we will be capable of building different type of relationship on top of that. And I believe, if you like, this would be my summary of our podcast today.
That's splendid, and we just have to work for another 10 or 20 years to make that happen, guys.
Look, even longer than that. We just said the 75 years old, you still have to work. Yeah,
I mean, I don't want to show my age, but in 1997 1996 is when I started using Hotmail, and look where we are now. And I still remember the Amazon IPO and whatnot, and it's just a couple of $1 trillion right there. So hopefully with DeFi, we will see similar sort of transformation of finance as we have seen of, grocery shopping and all of our e-commerce experiences. So let's make it happen, guys.
So Ajit, we centralized on Breaking Banks today, a wonderful discussion on decentralized finance. Awesome. We have Lex, we have Rune, we have Stani. It was a wonderful show. I invite our audience to stay tuned on Breaking Banks Europe and Breaking Banks, the general podcast, on all of the podcast platforms. We are on all of them, the one that you prefer. This was the 42nd episode. Stay with us for more.
Let's DeFi.
And this is a wrap.
Thanks for listening to Breaking Banks Europe, a Provoke Media podcast in cooperation with FinTech Stage. Don't forget to tweet us out, shout out, or post to the team at Breaking Banks EU on Twitter. If there's something or someone you'd like to hear on our cast, let us know. See you next week on Breaking Banks Europe.